Hi, I'm Dan Westfall. My company's Client Focused Financial. So today I'm going to talk about the problem with mutual funds. So if you don't know the difference between a mutual fund and a mutual friend, that's completely okay. Most of you out there that are watching this probably own a mutual fund in some way, whether that be in a savings account through a money market that you may have just general savings put into, or if you have a 401k, IRA, or a 403b plan. If you have money invested in those type of accounts, you probably have money put into a mutual fund in some form. Mutual funds are commonly used in those type of accounts because they offer a simple way to diversify your money. Diversification just really helps you spread out that risk that you take on when you're investing your money. Okay, so you're probably asking, what's the problem with a mutual fund then? So 3 things. Number 1, there's high fees. 2, they're not that tax efficient if they're outside of a retirement account. And then 3, they're really basic investment strategies. Number 1, high fees. So high fees eat away at your returns overall. The lower the fee, the more money you get to keep. So in many cases with mutual funds, there's both an upfront or a back end, what's called a load to it. That's basically just a sales charge. So if you have an IRA and you have mutual funds in there, if you look at the statement on it and it's an A share or it says A after the end of the mutual fund, that's an upfront loaded mutual fund. So if you put money into that, you could have been paying up to 5.5% when you first put money in. On the other side of things, the back end sales charge would be if you have a C behind the end of that mutual fund. That means that you're paying an extra 1% every single year above and beyond the general expense ratio that you really don't necessarily need to be paying. Mutual funds also generally have higher expense ratios. So an expense ratio is basically just a hidden fee. You don't see it coming out of your account. There's no line item on your statement. It's really just a hidden fee that's built into the fund itself. So typical expense ratios for a mutual fund can range anywhere from 0.5% all the way up to 2%. So depending on the mutual fund that you're using, they could be extremely expensive. So I'm not specifically talking about your index funds because index funds are the next thing to free, but index funds are purely just tracking a benchmark. I'm talking more specifically about mutual funds that are actively managed versus the ones that are like your Vanguard index fund where it's simply going to only do the average. Number 2, if the money that you have invested is in a taxable account, so a taxable account is something that's invested in anything outside of an IRA, 403b plan, or 401k plan, pretty much anything that's not a retirement account would more likely be a taxable account. In these taxable accounts, you don't control the taxes that you may have to pay with a mutual fund. So mutual funds buy and sell positions inside the fund, creating taxable events that are out of your control, but you still have to pay the tax on it despite not actually having the control over the sales being made. There are more efficient ways to avoid this, and it's by either using ETFs, or which ETF stands for Exchange Traded Fund, or individual positions if you have a large enough account size to where individual positions actually make sense for you to purchase all of them. This leads me to the last one, number 3. Mutual funds are typically broken down into basic investment strategies like you'll see in a 401k or 403b plan. A lot of them use these target date funds. That's one that says 2030 fund or 2040 fund. So they're very generically set up to where they're just in a basic stock bond mixture. As you get closer to that date, they put more into bonds versus stocks. Other examples would be like a large cap fund where it'll say large cap within the name of it, or maybe it says small cap. That just refers to what the fund is able to invest in. So a large cap fund just means that they're only going to invest in larger size companies. A small cap fund just means they're only going to invest in smaller size companies. Bond fund, same thing. They're only investing within bonds. The problem with this is the managers themselves are only moving it around within that specific asset class or based on whatever the prospectus says. So there's not a whole lot of adjustments that are being made based around your goals because, let's be real, these people have never met you. and most funds are too generic to really create a goals-based strategy that you may need for your investment portfolio. In summary, mutual funds are fine for beginners if you're putting $50 or $100 away in one of those index funds versus the loaded funds I talked about in the beginning. That's a fine way to just put money away to get it invested and have it diversified. Or if you don't have the option in a 401k or 403b plan because the only investments you can pick are mutual funds, you're kind of stuck to just playing within that field there. But if you have an IRA or a taxable account, you really should look at something else other than a mutual fund to invest in, because there's a lot more efficient type of investment strategies that you can use using other types of investment vehicles. I appreciate you taking the time to check me out today. If you're looking to check out more videos like this, click on the link above. That's my website. On the website, you can go to the Insights tab where I put all these videos out there. Also on the website, if you check out on the first page, if you want to look to see where your investment portfolio lines up, feel free to take the investor assessment on there. And if you also have questions about anything, feel free to reach out to me, DM me, call me, text me, whatever. My number's on the website there as well. Also, if you like this video and you think other people would like this video, click the share button below. Don't be selfish.